Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Today is Tuesday, January 17th of 2023, and thank you for joining us for our market insights and observations. Let's get right through our topics of the day. What we're paying attention to here at Blanke, Schein Wealth Management, as well as what you should be too as we navigate through the start of the new year and the portfolios that we manage. That being said, we've had some great help over the weekend and some interior design work that has been completed, or at least it's in the progress of it. We have interior signage right here that I'm showing you on the screen. It's in our El Paseo entrance. We also have one in the back entrance as well. So it's kind of exciting to have backlit, something we've been waiting for quite some time, and we're making some progress. But let's get right to what our main topics of the day are. We're just showing some photos from time to time because a lot of clients are asking about our new property, so we want to show it off as well. But the headline right now is there's no recession just yet. And that's the theme for 2023. And the real key here is, can the Federal Reserve engineer a soft landing? By that I mean, as we know, they've taken the Fed funds rate from just about 1.25% last year all the way up to about 4.5% as we speak right now. And the real question is, in February and then in March, will they raise interest rates a couple of more times? And if so, how big or small will that be? Well, we anticipate, yes, they will raise interest rates 25 basis points in February and potentially in March moving forward. Now, you also hear some construction in the background. I'm just going to keep rolling because we're still in the middle of everything in progress here. But getting back to the Federal Reserve and what they have to be focused on, we have to look at today's economic data, and that's what the real-time information is all about. As an example, the first chart I'm showing you is the New York Fed Manufacturing Index, and you can see here clearly on the screen as we go through this together, you have the trend line is actually headed down. It's down 32% year to date. And essentially what you're looking at is a report on business and manufacturing and then the future confidence of business owners, especially around the New York area in this particular case. But it's a very key indicator. It's the IMS indicator, and something that it's a forward indication of inflation as well. So it shows that the Fed's work that they did last year by raising interest rates has a clear impact on the confidence of business owners, therefore the demand side, and therefore hopefully tempering inflation. Now, inflation's there's two different components to inflation that we're going to be focused on. One is what's been peaked, so peak inflation this year. And think about that. Everything from food to energy, hopefully energy. Energy could always have a spike or a shock to the global markets. So we could see energy spike back up. But at this moment in time, food and energy have come down from last year. Autos and housing, another consumer-driven marketplace, but it's another key component to what the Federal Reserve is trying to do. And clearly we see some housing numbers. Housing is clearly slowing. If you look at autos right now, used car at least pricing in that market, that has come down dramatically, and it needed to for quite some time. As well as manufacturing, and that's the slide that I just showed you right now. What's the sticky part of the labor market of inflation is the labor market. And that's ultimately, again, what we're going to be paying attention to, and the Fed as well. Now, there are basically 10 million job openings, the JOLTS report, versus 6 million that are actually actively looking or working or looking for work right now. That report has gotten a little bit better because last year was 11 million, now it's down to 10 million. And that's ultimately what the Federal Reserve is trying to do. Their hope is that they can destroy the job openings, which they're making a progress on, before they destroy too many jobs. Now, if that happens, what is the impact or the hard or soft landing to the economy, i.e. the consumer, and the consumer then the ability to spend? And that holds up the S&P earnings. And so right now, historically speaking, if we look going back to the 70s, what this chart actually shows are the gray bars of recession. And recessions come along every once in a while, and we don't know if we're in a recession just yet. We have to see some things materialize, but we do know right now, right here, that we're seeing a decline in earnings per share, at least on a go forward basis. Now, earnings are coming in positive for last year, and if we go to the next chart, the S&P earnings that are projected for next year is the red line, the red dotted line, and The blue line is the $220 earnings per share if you look at the S&P together collectively. That's this right here. But the red line here, the 229, 230, that's what's projected, which means at the end of the day, earnings growth is projected for this year. And so what's happening is you've had the market on the NASDAQ and the S&P last year discount 20 and 30% respectively in terms of forecasting how deep the recession will be and what the impact to earnings actually will or may not materialize. But it's interesting, we still have earnings growth, and there are some other factors of growth that are being factored in for the second half of this year, which is the story that we just have to follow and see how companies navigate this. Now, this is what I spoke to earlier when I first started at this on my update for you today. And this is just a chart of the 10-year Treasury yield over the last since January of 2000. And we see obviously basically the 20-year decline in interest rates with a clear reversal last year. And then obviously with the Federal Reserve now taking interest rates and taking the short-term end of the yield curve, if you will, higher. And that pushed longer-term interest rates like the 10-year Treasury higher. But we're sitting at 345 right now for a 10-year. Now, we still have a 4.5 to 4.25%. There's a big 1% difference between the short term on the yield curve and the long term. That's called an inverted yield curve. So this also, when this happens, that's also recessionary indication on a moving going forward basis. So the recap of the overall wait and see environment. Ultimately, what we're seeing is corporations basically batten down the hatches. Margins and multiple expansions can still happen in a recession, especially in the back end of 2023. We just have to get there. And that's where the S&P 500s actually has had a quality start, about 4.5% year to date to start the new year. Again, we're managing and reallocating, rebalancing portfolios accordingly. We're taking advantage of opportunities, but we also own high quality companies that we know will not only grow, but also get stronger through recessions. In fact, historically, that's the name of the game here. So you want to be nimble and you want to take advantage of what the market gives to you. As I said last week on CNBC, we're just positioning for that as well. So that's our market insights and observations for today. We thank you for tuning in. Again, like and subscribe, and we're looking forward to seeing you soon. Take care.